we've come to just really accept that the global financial system is a lot more fragile than people want to assert it to be. And when you shape your life view from that perspective and outward, things like Bitcoin really start to look interesting.
This podcast is for informational and entertainment purposes only and is not investment, legal, or financial advice. Opinions are those of the host and guests and do not reflect any affiliated entities. Investing involves risk, and past performance is not indicative of future results. The host and guests may hold positions in discussed securities. Now, please enjoy the show. Jeff, thank you so much for joining me today. Super excited to chat with you. All right, Jeff, you are a portfolio manager and head of alpha strategies at Bitwise Asset Management. Bitwise is a crypto asset management firm with over 12 billion or roughly 12 billion in AUM. You previously worked in TradFi at places like Corbin Capital Partners, Harvard Management Company, Morgan Stanley, and you have a really incredible Substack. I think it's just called Jeff Park. The actual kind of URL or ticker, if you will, is called like Jeff Park 1. So highly suggest everyone subscribe. But Jeff, take me way back. Take me back to when you were first getting interested, or when you first first were intrigued by markets and assets and kind of the finance, because your breadth of knowledge in this space is incredible. And so, did that start at a really early age, or was that in college, or when was that?
Yeah, thank you for the kind words, Andrew. I actually am relatively late in my journey of learning about the world of investing growing up, mainly because neither of my parents were coming from the background of being financial services professionals. So I would say my journey actually began in college, and I had the privilege to attend Stanford, and we actually managed a part of the endowment's capital as a student-run investment organization, which is a super, super fun job. I got to be the president of it and learned a lot about stock picking from that experience. And that's nurtured my interest on Wall Street. And so I started my career at Morgan Stanley, as you alluded to. It's also actually where I discovered Bitcoin. And you might not find it totally surprising, because when I joined Morgan Stanley, it was 2008. And so one of the things that was really life shaping for me is you graduate from college with all the optimism in the world that you're going to do some great, amazing things. And then within 3 months of me starting my new job, the world imploded. And actually everything I ever thought I knew about macroeconomics and econ that I learned by textbooks didn't matter, because the things that were happening behind the scenes to then save the financial system were so unorthodox that you could never have even prepared for it by learning history. And so there are a few things I think that happened for people like me, but also maybe at a generational level. We've come to just really accept that the global financial system is a lot more fragile than people want to assert it to be. And when you shape your life view from that perspective and outward, things like Bitcoin really start to look interesting. And when I discovered Bitcoin, I was also an exotic derivatives trader. And so I loved volatility trading and arbitrage and all the ways that people don't always know how to price risk. And Bitcoin, as you know, is one of the most volatile assets, but also one of the most leptokurtic asset, where actually the tails are very fat, and therefore human psychology makes it challenging to gauge the possibilities of those fat tail events accurately. And in that sense, Bitcoin represented to me all the things that people would not be able to estimate its importance today. And they actually cannot understand it in the term structure of how long that thesis would take to play out. And so I've been following Bitcoin for a long time, over a decade. And it really is my first love of crypto. I think I will always be Bitcoin first, but nonetheless was intrigued by a lot of other things within blockchain technologies as a construct. And so decided to dive into that journey. At Corbin, I've spearheaded our digital assets investing effort professionally, starting in 2017. Personally, I was invested before, but 2017 is when I marked the capacity to do it professionally. And then I came to the conclusion that ultimately, to do it really well, you actually have to do it from a crypto principles first lens at a crypto native asset manager. So for me, it was a no-brainer that I would have to eventually leave and join a startup like Bitwise to augment and spearhead that effort.
That's amazing. Okay, so yeah, you were at Morgan Stanley, and that's where you first discovered Bitcoin, and it was '08. So it was like, you were doing exotic equity derivatives, which is a great way to kind of prime your brain to find these unusual assets. And then also 2008 happened. So it's another great way to kind of discover unusual assets and and look at the overall fragility of the financial ecosystem. So what was that first, take me back to that first kind of understanding of Bitcoin, because when I first understood it, I actually, well, when I first bought it and I didn't understand it at all. It took me actually a few months to understand the potential. And then by that point, I'd already sold it. And I was like, oh my gosh, blockchain is going to be transformative. It's amazing, blah, blah, blah. But for you, how, when you first discovered it, what was your reaction? Were you like, oh, that's interesting. It's a small toy. That's cool. Or was it like, oh my goodness, this is incredible?
Yeah, I think most similar to everyone else. I also thought it was a little bit funny and strange and a little toyish at first. I'm not gonna lie that the construct of it in itself was a little bit gimmicky. Nonetheless, um, the theory behind it, in a way that it solved the double spend problem, was intellectually kind of interesting. So it was my first time discovering the academia of cryptography to begin with, but it was like a really good crash course into actually things people have been working on for decades. And so you actually then realize, even though it sounds a little gimmicky, that there really have been like a lineage of really bright minds trying to focus on this for a long period of time. And when you then appreciate that lens, you start to give it a little more credit, a little more honor to the work that's been put forth, and then you're able to dispel that gimmickiness a little bit. Now it feels gimmicky at some level because we come with notions of what money should be, and at the time, as you know, Bitcoin was actually trying to be a money substitute first before it became a store of value construct. And from that lens, you reasonably could have a lot of thoughts as to why it might not work. And so I think it just took time, and it still takes time, as I think the journey is being discovered as to what exactly the end game of Bitcoin is going to represent. But all of these skepticisms, I think, is generally healthy, and it's generally pretty human to approach the idea of anything so revolutionary with some lens to that nature. Um, but I think for me, like, part of the professional experience being contributory, but at a personal level, I also spent my time growing up in Korea as well as the United States. And when I was in Korea is actually when we had the Asian financial crisis happen in 1997, where the IMF actually ended up bailing South Korea out. And if you live through moments like that as well, as a citizen of any sovereign, you do also then understand the notion of how money can be politicized, and actually, you do want to own things that are denominated in a different kind of creditworthiness. So that's also one of the reasons why I think Bitcoin was more intuitive to non-Americans first, because Americans have the incredible privilege of knowing that our dollars are pretty good in general, and they do store value relatively well. Um, but foreigners do not, right? You're actually at the mercy of your floating exchange rate always being impacted by the dollar, as we are living it right now, actually, where many countries already had Bitcoin all-time high last year, even before the Americans were trying to imagine breaking through 100K. Like that happened everywhere else in the world already in their relative pegged currencies.
So at Corbin, you mentioned that Corbin was getting intrigued or maybe involved within the crypto ecosystem back in, I think, 17.
Mhm.
And Corbin, from what research I've done, is it's like a 10 billion plus firm. So that's really surprising to me, because I haven't, I've heard of all the crypto native folks, but Corbin was from TradFi. So what was their interest in that? And were you kind of like the one leading that charge?
That's right. Yeah, I spearheaded that effort, and it was one that took a fair amount of time to actually get to the front of an IC to action investing. And the journey is multi-year, right? 2017 is when it began, but it actually wouldn't be a little bit until later that we'd actually be able to start to put some money to work. Um, we ran a multi-strategy effort across every part of the security segmentation you could imagine, from equities to credit to private credit to all kinds of esoteric asset-backed securities. And so, in some sense, Corbin is very versatile in being able to understand the uniqueness of any property. And so, crypto, I think, was one of those additional auxiliary assets that was intriguing. Um, the most challenging thing, and this won't surprise you, is that in 2017, crypto was still suffering from a little bit of a social stigma, if you will, that it is illegal, that it is actually used by money launderers and drug trafficking, and actually is a net negative ESG, even though I would have then and still argue it's the most positive ESG asset in the world. Um, so from a reputational perspective, like institutions have to manage that, right? And I would almost argue most institutional investors are operating from the mindset of being short the put, where, of course, you're excited by the upside you can capture, but it's relatively limited by the unlimited downside if you make one wrong step. And Bitcoin actually, in many ways, mentally is the ultimate long call option. And there would obviously then be a natural incentive mismatch for allocators to really understand the role of crypto for their business. That's all changing now, of course. I'm really excited by things like the Bitcoin standard and its adoption to corporate treasuries. We at Bitwise have an ETF we're launching in March that is going to be able to index public securities that are participating in the Bitcoin treasury strategies. So these things, I think, just changed in 7 to 8 years. Now it's almost silly to tell people like Bitcoin is immoral. I think there are now more people who are supporting it as a worthwhile endeavor.
So before digging deeper into Bitwise, a recurring theme that I've noticed with guests on this podcast are they've had very stellar careers, specifically in TradFi, primarily in TradFi, and there's no like they don't need to leave. Like they're doing very well in TradFi, and then especially when you jumped over to crypto, it's still considered potentially by some like a career risk because crypto's, as you mentioned, doesn't have the best. It's kind of viewed negatively by some. Now I think that as that is changing, but why did you decide to make that leap? Because that is a pretty significant change for someone with your background and experience.
Yeah, it's a really great question. I would say, first and foremost, my conviction in crypto, while at the very early years was uncertain, became unwavering in 2015 plus. Um, that's when I actually got to meet some of the brilliant minds that are now household names, but back then were not. Like, for example, I met Paul from Pantera in 2015 in like a West Village dive bar when ETH had just launched. And back then, the construct of ETH replacing lawyers was like the thing as a smart contract analogy. And when you meet people like him and others, you start to realize that risk is actually the other side. That there's a lot of really smart people making bets with their whole career and doing really interesting things. And you actually are taking risk by not having a foot in that door. So I had more FOMO on the other side where I felt compelled if I didn't spend time in this, that I would become obsolete in some ways. And I do feel lucky and privileged that I've had a great career in TradFi where many things were comfortable. But the reality is, when you look around, that wasn't the case for like most people. And the generational trend of the distrust in organizations and the disintermediation of trust and global debasement as a whole was going to be a secular trend. And so when you see the big picture, for me, I think by the time I made my decision, it was almost not even a risk question. It was a question of, is this my final journey? Like, is this the thing that I'm going to build my career on for the rest of my life? And by the time that Bitwise came to be, those are the moments that you realize the time is right. Because on the other side, a lot of crypto asset managers have come and go, right? And if you've been following, the ETF race began many years back, almost 10 years, and many firms did not survive long enough to launch the Bitcoin spot ETF. The Winklevoss twins didn't even end up bothering launching it, even though they were the first to file. And so the other thing that I was carefully studying is, demand is one, but is the supply there? Like, is there a credible organization that is actually going to withstand the test of time to build something worthwhile? And you needed organizations like that to exist as well. And Bitwise was born 7 years ago in 2017. Roughly, that's around when you got to see these great companies like Coinbase truly thrive, Anchorage come to market, and that really builds institutional comfort in a way that you can't imagine someone in TradFi who takes their career very seriously can then make that jump into joining other credible organizations with like-minded people.
What was the calculus on Bitwise specifically? Because again, you could have got, if you're deciding, okay, I'm going to make the leap into crypto, the world is your oyster because you have incredible experience. You're deeply knowledgeable about crypto in addition to TradFi. So, why Bitwise?
Great question. I felt, and I still feel, that asset management is an incredible business, and it's actually an incredible privilege to be able to manage other people's capital as a fiduciary. If you do that really well, I think it's the kind of business where you get to see a lot of things because at the intermediation of an asset management is the ability to see the underlying utilities in a different lens. So it's actually one where, as simple as it sounds, takes an incredible amount of dedication to succeed as well. And some of our peers actually maybe diversify their businesses where asset management exists next to banking and it exists next to sales and trading and the merchant banking model, and it's trying to be like a mini Goldman of crypto or something like that. What I loved about Bitwise was it was asset management or bust. Like that's all we're gonna do. It's actually really hard to do this right in itself, and the chance to earn client trust in a journey that is as controversial as crypto is enough to commit as a singular focus. And to me, that was something that deeply resonated with me. Um, it's also, I think, one of the reasons why Bitwise has succeeded because we actually have no other distraction besides onboarding investors about the opportunity set to access crypto in a thoughtful and well-regulated manner. So to me, it was almost a no-brainer with my background that this is the place that I could imagine building a franchise that could survive decades of existence. The next BlackRock, the next Blackstone will emerge from the idea of like this that we can compound upon. And then, it goes without saying, but it's really ultimately people's business. That's what asset management is. And I can tell you without a doubt that the people I work with at Bitwise are some of the best, if not actually, in my opinion, the best in crypto asset management that has been able to push that journey forward for many, many investors.
Very cool. Okay, so people in our space, in the crypto world, they understand crypto VC, fund of funds, crypto liquid slash hedge funds, but asset management is a little bit different. Could you kind of explain that or give a high level overview of how Bitwise is different than these other options that maybe LPs or investors have?
Sure. Yeah. Asset management in crypto is a multidimensional endeavor. On one hand, it is finance because we're managing investment vehicles under the guidance of the SEC and the CFTC and the products that we are offering, et cetera. But we are actually touching technology assets. So one of the things that was really important for Bitwise was actually, even though it is in the financial services industry, that our long-term vision would align with the ecosystem of what the technology movement represents. This is actually why Bitwise has investors that is capitalized by both titans of Wall Street as well as titans of Silicon Valley, right? We're talking about investors that are barbelling from likes of Stanley Druckenmiller and Henry Kravis, but all the way to the left as well, like Naval Ravikant and Eli Gill. And this is actually the story of crypto. It's actually not just a finance asset. It's a living, breathing asset that's also code. And so in that sense, asset management will look different. I truly think that Bitwise's moment to shine is now because when things like staking, for example, become permissionable here in the United States, and you have to start really thinking about what staking represents as a source of income, it's not a dividend, and it's really actually more likely to be a technology stack play than anything else. And so when those switches turn on, people are really going to ask the question of, do we want to have a capital partner who understands the deep stack of these opportunities that come from the crypto ecosystem itself? And in that sense, we are truly differentiated even versus an entity like BlackRock, where we actually have acquired one of the largest validator clients on the Ethereum network last year to build our Bitwise on-chain solutions, where we can directly offer those types of services, which is not what you call typical financial services, asset management services, but in fact, it is servicing digital assets in a way that you would imagine advisory looks like.
Could you walk me through some of your typical clients? Like, I don't know if you guys service family offices, institutions, et cetera, or probably a mixture of all, but, and what type of products are these folks trying to dig into, or do they want exposure to? Is it more like, hey, we want Bitcoin because, we're really excited, but we want it through you guys because of XYZ reasons? Or no, we want something crazy. We want some NFT, metaverse stuff. Yeah, tell me about the clientele and what they're actually searching for.
We meet all kinds of clients in our seat. I would say we actually probably have the largest distribution network within the United States in terms of RIA reach that we've cemented now for over 7 years. And it gives us a great lens as to what our investors want. And we try to build products based upon those queries. And so initially, before the Bitcoin spot ETF would come to life, a lot of investors would express they want to take crypto risk, but they can't really own tokens. And in that sense, we were one of the first that actually came out with a crypto equity ETF that would be able to capitalize upon the theme of crypto through equities as the instrument of implementation. That's been a very popular product. It's actually the first ETF that I think was approved to have the word crypto in it, which actually is challenging in how you navigate the name rule by the SEC. That's a story for another day, but it was a big success on Bitwise's behalf. And likewise, the thing that sometimes people underestimate is we really feel it's important to be a fiduciary of the space to help investors learn about the opportunity set. And so even as something easy as like launching a single token ETP of an asset requires that judgment, to be honest, right? You might see some of the issuers that we compete with out there that are launching anything that could stick on a wall. But at some level, we take the job seriously that we want to bring an investment wrapper to something that we believe is a worthwhile endeavor and a real project and something that is going to be meaningful for years to come that you would want exposure to. And so the flagship fund that Bitwise launched was our index fund. It's today still the world's largest crypto index fund. It's over $1 billion. And it's also publicly traded under the ticker BITW. And here you can actually get the top 10 market cap weighted token exposure of the universe. So we're talking about Bitcoin and Ethereum, of course, but a long tail of assets like Solana and Ripple and others. And we were the first to bring that product to market, which actually is what investors want. They want a diversified ability to access the most interesting pockets of crypto. On the other hand, my journey at Bitwise was to augment the capabilities by building actively managed strategies. So what I mentioned to you earlier are a little bit more passive in nature or index in nature. My contribution to Bitwise is building the alpha franchise. And so what does that mean? We have a multi-strategy solutions effort where we're actually harnessing all the orthogonal alpha vectors that is available within the crypto ecosystem and offering chances for investors to participate in the most unique and exceptionally differentiated opportunities that can only come from crypto. And the other things we're trying to do is launch thoughtful, active strategies within the ETF wrapper too. So we actually have trend following strategies in Bitcoin and ETH that we released last year. You may know that trend following is actually one of the best smart beta strategies you can run in crypto because it tends to be momentum driven and it's highly autocorrelated and it protects you from downside at the best times. So those are products we're excited about. And also later this year, we're launching options income strategies as well in the ETF wrapper, where we can harness the volatility premium for some of these crypto equities like a MicroStrategy or a Coinbase, where investors might find it to be valuable to add some active component on top of owning their favorite crypto stocks.
It's very cool. What's the difficulty in launching these new products? Is it like extremely arduous because you have to, I don't know, set the infrastructure, set the strategy, go talk to regulators, like, or is it relatively simple and you guys are just trying to target the most popular products, the most requested products?
Yeah, the product landscape in crypto can be varied, right? Launching a crypto equities ETF is a fundamentally different exercise than, for example, trying to launch a Solana ETP for the first time here in the United States. So it really depends on what kinds of products that we're trying to bring to market in terms of the challenges or the operational thresholds that exist in our ability to control timing. That being said, we are generally trying to launch products that are useful, things that people want. And there are a few things I feel very strongly convicted that makes crypto unique. One of them is that it is incredibly nascent. And so the chance to give investors access to nascent assets is in itself a worthwhile endeavor that you historically could not access otherwise and learn about that opportunity. The other thing is that crypto is incredibly volatile. And actually, the volatility itself is a harvestable premium that if you were to imagine monetizing that feature in itself is useful for a financial advisor, there's almost no better asset class than crypto, which is both volatile but also highly liquid that lets you manifest that end game. The reality is most highly volatile assets are not very liquid. That's why it's volatile, and that's why it's gappy, and that's why there's jump risks. It's actually really unusual in the history of financial assets to have both volatility and liquidity as a coexisting feature. And it could really only exist with crypto because of the representation of what it means to have a globally censorship resistant asset that is not interested just by Americans, but by the whole global population at large.
Could you dig into a bit more on the alpha strategy side? Because, are you looking at very crypto native strategies that are on chain and doing things like that? Are you looking at venture opportunities, or is it more equity focused? Like, what are these alpha? Yeah, could you dig a bit more into the alpha strategies?
Yeah, absolutely. Yes, and yes. Everything you mentioned is part of our comprehensive suite of what we imagine multi strategy should be. Um, the reality is that there's so many ways to make money in crypto. So many. Some of them can be really, really technical in nature, and then some can be fundamentally oriented in nature, and many exist on a spectrum, right? So, for example, on the very technical side, market making as a strategy is an incredibly profitable endeavor because if you think about the market structure of crypto, there's actually a lot of friction, right? There's friction because of regulatory jurisdictional constraints. There's friction because of the latency in which information travels between different formats of exchanges, whether it's centralized exchanges or decentralized exchanges that are trading the same asset, or whether it's because the volatility is so high that the bid offer themselves have to be wide enough that you can actually imagine crossing bid offer for an arbitrage that's really not possible except in crypto because of the volatility. So a market making strategy in itself generates alpha, but it doesn't take, price risk, right? You're not long crypto. You're actually just long volatility and volume at some level and driving a very high Sharpe ratio. And so that to me is like a very technical appreciation for like an alpha opportunity in crypto. Um, and there's many things like this. DeFi is another one where if you're able to participate in on-chain liquidity provisioning or bootstrapping certain projects, you are able to earn some outsized yields and opportunities that is actually exclusively reserved for the crypto natives and not those who are unable to navigate that experience. And so one of the common things sometimes I hear about are, for example, like people are just really disappointed Ethereum's price action has not been as interesting, and maybe it's even down in ways that maybe they're underwater. But what I tell these investors is partially the problem is that you may have been holding it wrong, which is that Ethereum is actually a productive asset. Like you have to do things with Ethereum to generate income where the person who's doing that has a natural cost basis advantage versus you who are not doing that, right? And so it's no difference than like if you have, you know, hundreds of dollars under a mattress, it's been debasing and losing money. Of course it has. You should have put that in a money market fund. Like why did you stack it under a mattress? And likewise, Ethereum is meant to be used, right? It's meant to participate in staking and restaking and participate in EigenLayer and all of the ways that there was value accrual for those who are able to navigate that journey. And so that's an alpha vector, right? If you do that, you can earn double-digit returns on a delta neutral basis also. And that's exciting. And then, even on the more fundamental side, you can actually just find alpha within crypto equities too, like trading Coinbase convertibles and MicroStrategy calls, options, and convertibles as an arbitrage relative to stock are all fair game in how you should imagine the totality of what's available in crypto. And so, for example, the election was, of course, momentous for crypto assets, and Bitcoin, of course, had an incredible run up in November as a result of it. But many also may have then missed, if you're just focusing on tokens, the best trade actually was Coinbase. Coinbase was the biggest winner in some sense because it actually had just released earnings in October that was not very good, that caused it to gap down. And so if you're able to take advantage of that at that moment in time on a relative basis to what the vol surface for Coinbase implied, if you bought call spreads or call options, that's actually the right trade. And so there's just a lot of different ways to appreciate what alpha can look like. And the goal at Bitwise is to give investors a chance to access a lot of these things in a comprehensive way to have like a truly all-weather crypto strategy that's not solely betting, on the price of Bitcoin. We always say, we love Bitcoin. If you want Bitcoin beta, you should just buy the ETF. It's really cheap, it's really liquid, and you can control its liquidity. If you want high risk adjusted returns, things that have better Sharpe ratio than Bitcoin itself, perhaps, and better drawdowns and better Sortino ratios, that's when the alpha solutions that we are offering our investors starts to make more sense.
So, you mentioned fundamentals, which is a funny word in crypto token markets because a lot of people argue, like, are there fundamentals in crypto tokens? And we see the meme coin trend, we see AI agents, which are kind of like meme coins in their current iteration, NFTs, of course, which are kind of there's difficulty in valuing them fundamentally in some instances, but there's also things like DeFi, which kind of do have revenues and whatnot. So, what role do fundamentals, quote unquote, play in crypto token markets?
Yeah, it really, really depends on how you're defining fundamental, in my opinion. Many, I think, people bring the biases of the security framework when you were describing fundamentals in that context, right? They're thinking about like fundamental stock valuation exercises. But actually, that's not, I would argue, how you value commodities at a fundamental level. And I'm using the same word, fundamental. But when you value, metals or oil, it's not actually the analysis at all that you're looking about cash flows or terminal value of an enterprise, et cetera. So the fundamentals really matters in the context of, is it a security or commodity? First and foremost, that's how I would lay it all out. If you think it's a commodity, then it's actually a very different fundamental exercise, which is really all about supply and demand. And that tends to look very different than the fundamental analysis you're alluding to on tokens, which is about security centric approaches, which is like, is it valued cheaply? Does it have cash flow? Is it growing? Is it actually operating efficiently? All the things that you apply to the lens of like the value method of like, the intelligent investor. That's another way to think about it. And one that I don't think actually has worked in crypto as well. And so why hasn't it worked? It hasn't worked because there hasn't been a regulatory environment that allowed you to actually participate in all the language we know how to think about security selection alpha. So if you can't distribute uh, the actual income that is associated with the productivity of your protocol in ways that investors can understand it, then it's actually not a security at all in the way that you should be underwriting it. It's not about user growth and all that stuff because it doesn't matter what those numbers ultimately do if you can't find a way to monetize the value capture of that token. Right? A stock is only as good as the fact that it pays dividends or somebody else might buy it out because they want to acquire the company. You don't see token mergers, right? It's not like token like foundations buy other tokens to like merge it, at least in a serious way. You hear about it in small projects, but not in like a serious way. And you need regulatory clarity for any of that to actually work because ultimately you need a permanent capital vehicle for fundamental analysis to work. If you think about the journey of equities, right, it might start off as a venture investment. Maybe it was incubated at Y Combinator and then it found some VCs along the way. It IPOs. It ends up at some hedge fund or maybe some growth equity funds, but eventually it matures even more. And then it enters into a mutual fund and then maybe eventually enters into an index. And then the graduation of the investor ultimately is the thing that de-risks the asset, right? The journey from being a Series A company into then ending up in an index fund is actually just a journey of risk reduction and finding the next capital base that is willing to evaluate that at that risk preferential. But in crypto, if you don't have permanent capital holding vehicles, there is no graduation. It just is the same pool of capital. And that is ultimately kind of problematic from the analysis of like the securities. That's why I say it looks more like a commodity, right? Because that's actually what commodities are. These commodities just move around between players, but there isn't like a permanent capital vehicle that it is graduating into the way equities do.
Building off that, how do you view the programmable nature of the assets themselves? Like for example, talking about commodities and securities, something can launch that feels and looks like a commodity, and maybe the developers and the foundation and whatnot, they change the actual mechanisms of how the asset works to maybe eventually evolve into a security, or vice versa. So how do you view the programmability of the actual assets themselves?
Yeah, this is the kind of stuff that I think is the unique challenges that Washington is going to hammer out over the coming months, right? This is what Fit 21 is ultimately trying to address. All the market structure bills as to which regulatory agency should have oversight to the products that are existing here in the United States, and And the demarcation between commodities and securities thus far has been ambiguous. At this point, I think that the general trend is to really think of crypto as commodities first and foremost, unless there were exceptional reasons to consider it a security. But on the other side, the actual offering of an investment contract in itself is always likely going to be a security. So if you've been following the cases with Ripple and their lawsuit, a lot of the consensus agreements that are coming through is that Ripple in it of itself, the token may be a token, but the way in which it had gone through the fundraising as offering an investment contract could have been a securities offering. And those are the distinctions that I think are now being hammered out to imagine how to navigate the journey of capital formation, but that capital formation itself not ultimately leading to the creation of a security.
So you've said that and this is kind of a different topic now, but you said that I've seen you on X saying that the 60/40 portfolio is essentially dead. Why is it dead, and what's replacing it, if anything?
Yeah. The 60/40 is, in my opinion, dead because the fundamental social contract of what that portfolio theory represents is over. Um, so, what do I mean by that? There used to be a manifesto for a certain generation that equities and bonds should be uncorrelated because they're basically taking advantage of different risk preferences amongst investors, right? So, you know, when equities go down, bonds should do well because rates are probably going to come in, and therefore it's better for fixed income as we enter a recessionary environment. And so there were ways to imagine they're uncorrelated and it actually serves the investors to have both. What I think, though, over time, people have come to realize is that they're pretty correlated, actually. And they don't behave in the ways that the textbooks explained it in the 80s and the 90s anymore because the world has changed. So, what has changed? I would broadly highlight two things. One is the amount of correlation in the financial system has just generally increased. And it's a function of hyperfinancialization where a lot of the flows are no longer coming from rational price discovery. It's coming from sovereign flows or cross-border flows in ways that is actually not driven anything about the fundamental analysis of anything, right? So like, if Japan needs to take exposure to US equities because they're actually at such a low rate environment, they don't care what price US stocks are at. They just buy US stocks and that distorts the market. And those kinds of cross-border flows has just gotten really, really, really big over the years. So that's one reason. The other reason is I don't think stocks are even valued anymore in the ways that Benjamin Graham would have wrote in his book about. It actually doesn't matter because the way that people think about productivity within companies has in itself somewhat changed. So, like, if you think about the concept of a GDP as a way to think about economic productivity, that already today, even the Treasury Secretary put out a memo 2 weeks ago, is somewhat flawed because the G in the equation of GDP, right, government expenditures, is too big. And isn't it a little circular that government expenditures is actually the thing that contributes to what we call growth? I mean, that's fiscal dominance right there. Like if GDP goes up because government is spending more, that's not the way we've understood what equities should be. And so the very idea of 60/40 is that it's actually just becoming so much more correlated. And that's what you've seen. I put on Twitter, like the last 3 years, the correlation now is at an all-time high. They don't actually diversify each other at all. And so 60/40 is actually 100 of something. And the goal is actually to find what is the 40 that gives you true resistance and diversification from that portfolio. And that's the journey of the radical portfolio theory.
Yeah, you mentioned Benjamin Graham and the Intelligent Investor. I always see the meme of people putting the book in the trash now. I see that all over Twitter because it just doesn't make any sense now. So no, I totally can see that. So, I guess you suggest that instead of the 60/40, you're talking about the radical portfolio theory now. Could you describe kind of what that is?
Yeah, absolutely. So the advice that I am trying to bestow upon investors to be open-minded for our generation in particular is to think differently about portfolio allocation. Really, really think about what you want in terms of diversification and seek those assets if they have the ability to stand on the merits of being truly diversified. And the lens that I'm applying as to how you should think about diversification is the radical portfolio theory. So, on one hand, the asset has to look just really different than the assets that are in the 60/40 regime. One of them, therefore, is putting value to things that are scarce, right? Because equities and bonds and all these things exist in like an abundance of liquidity. This is actually why things are getting out of hand. And it's actually really easy to just like print more money. Like you just print more money and there's nothing stopping you. But there are things in life that is actually not that easy. Bitcoin, for example, mining is not easy, and it actually does require resources that can in itself be scarce to produce something else that is scarce. And those things are actually not like press a button, there's more of it. Um, Something similar like that could be like high end, like valuable art, right? Like these art take a lot of creative productivity, right? These artists are not like using a printing copy machine to like produce all these original art. It's one of a kind stuff. It's real labor. It's like true physical human labor. And those things are inherently valuable than like the financial manipulation of liquidity. So scarcity is one way to look at it. The other lens is actually having assets that can be custodied a little bit differently than the system that we know. So if you really believe that there's a world in which there's going to be a premium on things that are held in a non-custodial way because of the way that hyperfinancialization is really centralizing all the forces of financial asset ownership, then owning assets that you can actually self-custody should have a premium. That's where gold bars, I think, get really interesting relative to like GLD, the ETF. I think for Bitcoin that is self-custody is a little more interesting than Bitcoin that is in the ETF, for example. And that premium differential should materialize over time as well. And the last thing really is being censorship resistant. Like you want to own things ultimately that don't participate in that global carry trade regime that creates all this interconnectedness. So you just want to own things that are detached from that system, which then by definition means that there's probably not a lot of leverage you can put on it because it's not actually an asset that can be underwritten with that kind of liquidity. So that's where like real estate always gets interesting in some sense because they're scarce, but they're also uncorrelated generally. If you find the right kinds of real estate or real assets that is not participating in that system. And there's a whole bunch of these things. And I've tried to sketch out a bunch on my Substack to give people a chance to really think about it differently. Um, and uh, and that's kind of the ethos that I'm trying to bring upon here.
Very cool. Yeah, no, so building off that, you wrote this incredible, I guess, series of posts, both on X and also in your Substack. It was called like resistance assets, and you know, it was touching upon the scarce assets, but touched on land, art, gold, biotech IP, litigation finance, Birkin bags, irreplaceable collectibles, offshore residences, yachts, drugs, life settlement funds, rare breed livestock, carbon credits, water rights, space IP, music IP, sports franchise, et cetera, et cetera. It was so good. It was so good. So highly suggest everyone to dig into that because it was just very eye opening and it's really cool to kind of explore the universe of assets, especially being in crypto where universe is already quite broad, but we're in our own little crypto universe. And then when you expand out of that, you can see that, oh, it's not just equities and bonds and crypto. It's actually there's a whole universe of assets that are very, very intriguing. So anyhow, yeah, no, I highly suggest people check that out. But thank you for
Thank you for that plug. One thing that maybe I can add here is to ultimately back to your original question, like why is 60/40 broken? 60/40 is broken because the social contract of 60/40 is that you're essentially um, taking liquidity from the future generation, right? That's what bonds represent. And I think the current generation has realized that this is not a game that they want to play anymore. They do not want to continue to fund the current generation at the cost of their own. And that's what 60/40 represents. And it's actually what I would call to be a wide manipulation of time. Like it's actually just financial manipulation of time itself as the variable. And what the things that you just described on that list represent is things that really cannot be manipulated by time. And because the other side of time is energy, and all the things you listed actually just require a ton of energy to create. Like IPs are great examples. that you just cannot copy paste. Like it has to come from hard work, blood and sweat of somebody doing the work. And those things are valuable precisely because you can't manipulate the time value out of it. And it's actually energy on the other side. And so maybe a simple way to think about it is if you think the 60 allocation today in the compliance world is things that are based on time, the thing you want to find on the 40% is things that are really valued on energy and the scarcity of energy that is then converted into something else. So that's of course Bitcoin. We know that story, but that's where also art fits in. That's where also IP and litigation financing fits in. And all those things become useful as a different way to think about like what is valuable in the spectrum of time versus energy.
All right, so that brings to mind, and this is a biggie. That brings to mind AI, right? Because AI is essentially like the ultimate labor reduction force of all time, potentially. Is still, is still in the progress. But how does that play out? Because, for example, IP, if I have an AGI that's extremely intelligent and it can create some, or, go through and create some new biotech IP or even music and film IP that for a human would take, 100 days, but for this AI, it takes an hour. How does that change the game when it comes to finance and assets and markets?
Yeah, it's a great question. And we don't know exactly what the end game of AI is going to look like at the enterprise level for consumers. But without answering that particular question, I think what I will always fundamentally have conviction is that the asset there isn't AI, it's data. It's data that's the fuel that gives AI the things that it's able to do. And data is valuable. Why? Again, because data is proprietary to the person who's been able to create it. It takes energy, right? Data is not something that exists by itself. Somebody created it. Somebody wrote something that fed into their inference model. Somebody collected data on like the weather out there that is now publicly available. Like someone did the work to create that data. And so the question is, how can data then be monetizable to the attribution of the creator? And that's where I really think crypto is going to play a huge role in the intersection of AI and crypto. Because if you take out AI as just kind of the middleware in converting data into something else, the battery, the energy source is actually the inherent native data. And so the person that's able to create it, if you had the attribution ability, then that's one way to think about owning an asset that is actually proprietary to you, that is going to reward you for your human capital. So I think all the arguments that are unfolding right now live today about like OpenAI having started as a nonprofit, but then has gone for profit and is actually harvesting things to like create these toolings without permission of like the actual creators of those content. I think that's a real problem. I actually think that is the theft. And so you have to imagine there's going to be another model where you decentralize the contribution of that data with the attribution quality to the individuals that have been creating it. Um, it's a challenging problem, technically speaking, but it feels to me the kind that crypto is like meeting its moment of now to actually imagine the attribution qualities to be the underpinning of developing AI toolings.
No, that's really incredible. I haven't thought about it like that until you just spoke about it. The attribution, number one, number two, kind of micropayments and the ability for anyone in the world to contribute their data to this AI or to the system and get compensated for it. That's a really, really, really cool vision. So what do you think about and I'm kind of going on a tangent here, but what do you think about the new administration and their stance on tariffs and kind of this different way of running the economy and the deficit and everything like that than what we had previously? Because I feel like previously the past couple administrations have been kind of in lockstep a little bit, similar model. Now I feel like we've kind of thrown all that out and we're like, hey, we're trying new stuff completely. A lot of folks are saying, hey, this is going to be very destructive to markets. A lot of folks are saying the opposite. It's going to be amazing for markets. What is your take, and how does that impact? How does the new administration's policies? How do you think it'll impact markets and crypto?
I think the impacts will be twofold. One is there's going to be a lot more uncertainty premium baked in. So people are not going to be able to take as much concentrated risk as that they have been historically used to. Naturally, because I think the volatility will be higher. So, you don't want to wake up to a shocking news story that like creates volatility with gap risks as a macro trader that you can't possibly underwrite. So you're just automatically going to reduce risk. So that's one obvious takeaway. Um, the second thing, though, as a result, is that eventually the every macro trader is going to ask, like, what's the terminal state for where policy is going towards, in which I can make longer dated bets. So I'm not going to trade like short term stuff, but I want to make like 5-year bets and where the world is going to be. So you're going to see a migration of risk across the tenor, as well as actually the size of those risks, in my opinion. Um, and taking a step back on the actual administration's policies themselves, um, the reality is that we have taken for granted that globalization has been working, because globalization ultimately requires mutual cooperation of all your trading partners, right? It's actually game theory. Like, there's a game theory about, defecting and agreeing to work together, and generally the best outcome is actually not everyone agreeing to work together. There's the best outcome for the country that defects, right? But the general idea of game theory thus is that actually with cooperation, even though not every country is getting their own best outcome, the whole system is better off. And that's actually why globalization was brought in with such excitement. But underpinning that again is that asterisk: everyone has to play by the same rule. And I think what we've all realized over time is that not everyone is playing by the same rule. And actually, there are cheaters. And what I think is somewhat refreshing is that we're trying to have those dialogues in an open way to protect US interests at heart. And I know sometimes it gets political as to how people perceive what the Trump administration is doing, um, as somewhat adversarial to their trading partners. But actually, that's what diplomacy is. Like, that's actually the world in which global trade exists. And so, if the social contract is broken and there are defectors, then the US cannot be the one holding the system up by themselves. They have to then adjust to a new regime where they're actually now able to participate along the same grounds. And I think that's why we're seeing all these issues escalate with tariffs, because the end of globalization really means that we're entering a world of more protectionist policies. And if the rest of the world is doing that, then the US also has to lead the way and dictate the terms and how they're imagining they're going to do that. Um, and so, even though we don't know the end game, I think there are some implications of what this means for the dollar, for 10-year rates, and all the things that inform people on where the future of Bitcoin and crypto could go. This is why I think 2025 is actually the year of crypto and macro meeting at the forefront. It's actually going to be more important now than ever to know macro to trade Bitcoin, because actually there's such a direct impact to the dollar strength and 10-year rates, the two most important things with dollar policies that have some aftermath effects to Bitcoin's price discovery.
So 10-year rates, and how is that going to play a role in Bitcoin's price action over the coming years?
10-year rates is the most important rate on the yield curve, mostly because it anchors people's cost of living broadly, right? Mortgages are indexed to 10-year rates. And it's actually the amount of like the duration trade-off that people are willing to tolerate, whereas as T-bills are somewhat irrelevant, right? T-bills are kind of short term, but there's no real DV01 baked into those. And so the 10-year is relatively high in a period that is challenging to support the growth model for the US GDP growth rate. And so if you imagine the 10-year rate is going to go down, and that's a big if. There's a lot of people who think that it might not happen or it can't be willed, but if you imagine it can be taken down, what that ultimately does is that it introduces a lot more risk appetite and risk capital. And ultimately, risk capital tends to seek the fastest horse, and Bitcoin is one of the fastest horses that benefit on the tailwind of risk asset increase. And so there's actually, I think, the strongest correlation with 10-year rates and Bitcoin price than actually anything else that it might correlate to with, tech stocks or risk on equities or whatever that other people, talk about more frequently.
What role, if any, will stablecoins play? Because I know that from following you on Twitter and whatnot, um, this administration likely wants to decrease the value of the dollar so we can export more goods and whatnot. Do you think stablecoins? Because I'm kind of the opinion that we could be heading into a world where the entire world is operating on stables, U.S. dominated stables. Um, what are your thoughts on how stables are going to evolve and how that will play a role in economic policy, if any? And do you see a world where everyone is using stable coins, like USD denominated stable coins?
I think that is the hope. Um, the reality is, though, that's not actually what's been happening with the dollar. So if you kind of study the dollar usage over the past 5 years or so, the amount of transactions that are happening denominated as a percentage has been going down, meaning other currencies are kind of fighting for their share there. When that's not good, right? And that's actually the opposite of what stablecoin usage might be, as you're alluding to. The other thing that's been really unfortunate for the dollar is, though, people are hoarding more of it because they think it's a store of value for most foreigners. And that's actually also bad for dollar policy. So the general trend of the dollar has not been great. And stable coins actually can offset a lot of those things. As you've described, maybe it does allow more utility for transactions in a way that brings dollars back into the flows and as the base currency. But the challenging part is, how do you actually make foreigners hold less dollars? Because that's what's creating such dollar strength that is hurting the export economy of this country. And the unique thing that stablecoin can do is actually engage in some maturity transformation to allow that to potentially be financially engineered. And I think there's a lot of creative ways to think about it. But the end game ultimately is that if you believe that foreigners are going to benefit from the privilege of transacting in dollars, that the trade-off might have to come in a different way, where the U.S. will demand something out of it. And so, like a version that I'm imagining is that you actually have a stable coin that is not just backed by T-bills, because we actually don't need more T-bills in it right now. We actually need people to buy more long-dated bonds to bring long end of the rates curve back down. And so you could imagine actually creating a stablecoin backed by a mix of yield strips across the term structure, right? And so then, your naysayers would say, hey, but that's not going to then be pegged to a dollar because, of course, like the movement in 10 years is actually pretty big on the nominal par value of the bond. But actually, what you could do is just securitize that vehicle too and create a senior tranche and a mezz tranche and a junior tranche. And then you can almost imagine the senior tranche of that structure then becomes the stablecoin, where there's actually no risk of impairment if you subordinate the equity enough. And so I think there's different creative ways to imagine like achieving a goal where the US gets to borrow more on the long end of the curve, which also then reduces the need for dollar velocity because you don't have to refinance it every 3 months to a year. And that actually then would also bring the dollar in while you get the benefit of lowering rates in the long term. And that's kind of the holy grail, right? Like that's actually what you want to accomplish. And stable coins, as I described to you, can maybe be the conduit to accomplish these goals.
That's a really cool idea. Is that something that you're noodling on? Any sort of startup ideas, Jeff? Are we thinking that?
Oh my gosh. I think there are so many brilliant stablecoin founders out there that if any of them are listening and this idea helped them see an idea, I'd be more than privileged to have contributed in that way. But look, I think stablecoins is a killer use case of crypto, right? Of course, everyone wants to transact in dollars in a frictionless way, and we should try to find a way to permit it. At the same time, these investors want decentralized settlement layers, and you actually would want that as a non-American too. And so, I also refer to like the history of the Eurodollar. When the Eurodollar first came to be post World War II, it actually, when it wasn't like explicitly illegal, it was actually kind of not legal either, right? Because you're essentially letting all these European entities create the dollars offshore without backing. But the US kind of turned the blind eye on it because it helped them export the dollar in a way that there was liquidity being manufactured offshore, right? I mean, that's pretty crazy, right? Like, that's actually not very different than like the story of Tether, which is like Tether obviously is creating demand offshore for dollars, and the US kind of likes it. So they want it to be, and and at the same time, they're just trying to feel out like what that end goal might look like. And so um, in a lot of ways, to me, like Tether represents like a real secular trend, which is like people just really want frictionless dollar transfers, but they also don't want it to be on American rails, which is like not that dissimilar from why Eurodollars came to exist. And Tether is just a digital rebirth of that same construct where there's like a conflicting role of the dollar for domestic and international goals.
That's really cool. All right, Jeff, this has been amazing. But last question before we jump into the closing questions. How are the institutions viewing crypto now? Because you've been in the space for quite some time. You've been on the institutional side and TradFi and now in crypto. Is there really a massive shift, or is it still kind of slow and steady and people are dipping their toes in?
I would say that it is an ongoing effort. I would love to tell you that institutions are rushing to the door to invest in crypto. I don't think that's the case. And as I described to you, institutions are generally kind of short the put for their job, and crypto represents the ultimate long call. So there really is like a little bit of an incentive mismatch. That being said, I think many are doing their homework and many are secretly doing things without publicly disclosing that they own crypto assets because, again, they're short the put from a reputational perspective, but they want to recoup the chance to say they won if it works out. So, like, these things are happening where you see investors actually participating in crypto very, very secretly and almost privately. Um, I would say most of them are interested in Bitcoin because I think Bitcoin is something that can be wrapped around people's head into the idea of hedging for global debasement. Um, Whereas the rest of the crypto sector, I think we need regulatory clarity for people to then imagine that permanent capital endgame to dip your toes in. Now, the other thing that I will say is if there is one thing that has changed a little bit as I've sensed it, is that 4 or 5 years ago, a lot of investors wanted to invest in VC as a way to express their interest in crypto because they believed in this decade-long vision, this technology arc that's going to be revolutionary, and they want to make that long-term VC-esque bet. However, I think they've now realized that actually the opportunity for crypto might be on the liquid side. And the reason I think they know that is you know it and I know it, and I think we all generally have intuited if you've been in crypto, is that again, crypto is really volatile. And if you believe volatility is a harvestable premium, you don't really want to lock that up for 10 years and imagine you're not earning a yield off of that duration lockup. And so you actually should participate in the near end of the term structure in all the profit opportunities that is possible by the inherent feature of its volatility. Put another word, if you thought the S&P 500 was like an 8% return over a cycle, people choose private equity to earn 15, 20% because they believe that locking up your capital for 10 years is worth that illiquidity premium, right? That 700 to 1,000 basis point spread. But that's also because the S&P is like 20 vol on a bad day, 15 in general on a good day, maybe even lower, 12 on a really good day. But crypto vol is 60 to 100, right? So if you just equate the volatility premium, and I'm telling you crypto vol is 60, which is why we get astronomical liquid returns, the venture equivalent return you should demand for locking up crypto for 10 years is not 25%. You should want to like 250%. And I think most investors are now realizing actually crypto venture in that sense is maybe not going to give me the return profile relative to a liquid allocation, which is actually profiting off of all the alpha vectors that we talked about a little bit earlier today. And I think that is a noticeable trend that I'm sensing, that institutional investors are actually realizing liquid, all things considered, is a really interesting pocket of opportunity to play in.
Yeah, yeah, man, I have so many more questions I want to ask you, but I know we're coming up in time here. But you'll have to come back on again in the future, and we'll go through all the other questions. But alrighty, so I have to do this one, of course. What do you think the price of Bitcoin will be in February of 2026, 1 year from now?
February 26. I'm going to go with conservatively 175K.
Ooh, I like it. I love it. All right, if you were forced to leave Bitwise, you had to launch your own vehicle. What strategy or strategies would you focus on?
If I were to leave Bitwise and choose a non-crypto centric strategy, I would love one day to launch a poly market strategy.
Very cool. A poly
Yeah,
market strategy. So that would be just being active on poly market and focusing fully on that. That's super interesting.
yeah. Can't do it. now because you're a US, onshore investors can't access it, but we now have a new CFTC chair who I think is very bullish on the category generally of information markets. And so if you can imagine that US investors can now start capital formation to put intelligent bets on information markets like Polymarket, I mean, I think there's a lot of opportunities to generate alpha there that is uncorrelated to anything else in the market.
Very interesting. And would you want to specialize within the because poly market? There's so many different options of what you can focus on. Would you want to focus on a subsector like sports or politics, or like no? The idea is you want to.
Everything. Yeah, it's the multi-strat information fund.
That's so cool. That's really cool. I love that.
Yeah, I need like a Taylor Swifty like hard fans to get insight of her relationship status with Travis and make a bet on that. And that's not the same thing as making a bet on, whether MicroStrategy is going to be included in the S&P 500. I mean, these are all really vibrant markets.
It's so cool. Very cool. All right. What is the best investment advice you've ever received?
Well, when I started my career out trading, my mentor at the time gave me this advice. He told me rule number 1 was don't F up. And rule number 2 is there's no rule number 2. There's only rule number 1.
I love it. That's great.
Maybe the thing that I would instill is, always just be meticulous and careful in all the underwrites that you're doing so that you minimize the chance for slip ups.
I love that. That's great. All right. What trend do you think is totally overhyped, and what trend do you think is underhyped?
I think the trend of the Bitcoin Strategic Reserve and the Sovereign Wealth Fund and all of the ways that the US is going to start stockpiling crypto is overhyped. I've said it before on other conversations, but I don't think the US can unilaterally just decide to do that on their own without the cooperation of, again, their trading partners like Japan, who would actually be really incredibly annoyed if the US did that on their own. And the Japan didn't get a chance to do it alongside and what it represents for like the fiscal deficit calculations. And so I don't think it's possible to imagine that's going to be a near-term event. I think that's overhyped at the federal level, right? I'm talking about like federal treasury like level endeavors. The thing that is underhyped, I think, is stablecoins. I think that the world right now is sleeping on it, and the energy that I've been able to sense from at least my conduits to DC and the public policy research analysts is stablecoin is on fire. It is going to happen in the next 4 or 5 months in ways we're going to see a lot of airtime in the capture of like the public media that stablecoins is coming. And we're talking like June plus, where things are going to start really materializing. I think people are underestimating how quickly it's moving. And that's the story for 2025.
That's very cool. I mean, man, we could have a whole conversation around those two topics there because I want to dig deeper, but we have to keep going. All right. What trends or opportunities will define the future of investing over the next decade?
Love this question. One noticeable trend is that the world is just becoming crazier. And what I mean by crazier is that improbable events are happening more seemingly in ways that models would never tell you. It's not that different from disinformation campaigns in general, where people are generally losing trust of the middle part of the curve. And so when the national and international psyche is moving in that direction, the market reflects the same outcome, which is the wings are just getting really, really fat. And so when young people make these degenerate investments into things like meme coins or meme stocks, or they're buying 2x levered funds or 0-day expiry options, all of those things are actually, in my opinion, a rational response to the situation that they're in, which is that they're purposely risk seeking. I think that's a trend, and it's not going to change. And as a result, the thing that I think is most helpful to guide that journey is that everyone just needs to think about the world on a more probabilistic basis and less on a deterministic basis. Because once you start understanding the world through a probabilistic lens, that there is no such thing as like, truth and then basically misinformation, but actually it's probably in between somewhere where the truth actually lies, and you're able to see the world through that lens. There's just going to be more investing alpha that you can generate because the market will reflect the exact same underlying psyche as a trend.
Man, another banger. I want to dig deeper into that, but all right, Jeff, thank you so much. This was incredible. Where can people find more about yourself and learn more about Bitwise?
I'm on Twitter. My handle is DGT10011. You can often find me there. You also reference my Substack, which I'm grateful for my readership there. And otherwise, You can generally find me on the Bitwise roadshows throughout the country, and otherwise, more information about what we offer on the active alpha solutions on our website at bitwiseinvestments.com.
Amazing. Thank you, Jeff.
Thanks, Andrew, for having me. Talk soon.